Welcome to another edition of the Financial Commute. I'm your host, Chris Galeski. I'm really excited to have Sasan Faiz, Managing Director of Investments here at Morton Wealth. Over 20 years of experience in managing money in the wealth industry. And so I'm really excited to have him here as a guest. We're here today to talk about investing in international companies or international countries. I think that most people have a home country bias when it comes to investing, but I'd love to hear some thoughts from Sasan about why international is so attractive and why people should be focused on not only investing in their home country, but also in international countries as well. So, Sasan, thank you for joining us today.
Yeah, thanks for inviting me, and look forward to talking about this really interesting topic of global diversification, why it makes sense. So actually, I think, as you mentioned, every investor usually has a home country bias, and that's just natural that you want to invest where your home country is. In the US, obviously, most investors want to be focused more on US stocks. Just globally looking at the big picture, though, US is about 24% of global GDP.
Wow.
So the global percent of global economy. But U.S. stocks are 60% of the global stock markets. So there's still 40% of the global stock markets that are outside of the U.S. And I think a good question is, why do we even care? Why do we need exposure to those companies?
Yeah, so why do we care?
Yeah, I think if again, recently it's been beneficial from a performance point of view to be invested in U.S. stocks. Yeah. However, if you look back from 2000 to 2010, and this is a 10-year period that's referred to as the lost decade in U.S. stocks. Yeah. So U.S. stocks, as measured by S&P 500, actually lost a little less than 1% a year for that 10-year period. So that was obviously the aftermath of the dot-com bubble. There was a lot of speculation in technology companies and biotech type companies, and that ended with a major correction in stocks, where U.S. stocks were down over 50%. Yeah. During that same 10-year period, that was the growth of China and emerging markets, a lot of infrastructure spending in China and emerging markets. You're looking at MSCI EAFE, which is a measure of international developed stocks. That was actually up during that period, not as much as emerging markets, which was up almost 9.5% per year.
Per year, so 9% annualized for that 10-year period.
Versus minus 1%, less than 1% for U.S. stocks. Yeah. So having been diversified globally during that period made a lot of sense. Now, what we've had since the global financial crisis of 2008, which was more of a U.S. mortgage subprime crisis. Right. We've had a lot of very aggressive monetary policy. So interest rates, the Federal Reserve brought interest rates down to zero. Yeah. They started buying a lot of bonds, and that helped the economy and the stock market to recover. Yeah. But also with that recovery, there was a lot of speculation again starting to build into the stock market. Valuations for U.S. stocks have become very stretched. Yeah. So at Morton Wealth, we've been very concerned about the valuations in U.S. stocks. So we've actually lowered our exposure to stocks in general, but also in U.S. stocks, because we think the valuations didn't justify where the prices were. So again, what you've seen this year is, as interest rates have started to go up in response to inflation, we've seen that we've had a major correction in more speculative part of the market, which kind of smaller cap technology companies, biotech companies, but also the big kind of technology companies and S&P 500 companies are down double digits, 16-17% on average. So we're seeing that valuations coming down, and going forward, we don't have that tailwind of monetary policy helping U.S. stocks anymore. And the economy is slowing down, so you don't have the growth and visibility that was associated with the last 12 years, which has been a period where U.S. stocks have done well. So to us, again, nobody has the crystal ball knowing what and when international stocks are going to do better. Obviously, the big picture right now globally is not positive for international stocks either. Most likely, Europe is already in a recession. Again, they're dealing with issues that the US doesn't have. For example, energy that they have to import from Russia, and they're very dependent on that. So most likely Europe is already in a recession, but valuations also justify, kind of taking a look at that market, because we're looking at US market, for example, is selling at almost 17 to 18 times earnings for next year, even though we don't know what those earnings are going to materialize or not. But valuations are very high historically. So just to put things in perspective, back in 2011, when US stocks were at the low level, that price to earnings ratio was around 11. So there's no magic number what it should be or where it would be attractive, but 17, 18 versus 11, obviously that seems pretty high. Now, in comparison, when you look at the international developed stocks in Europe or Japan, valuations are more reasonable. So they're selling about 12 times earnings. So it's not as expensive. You're looking at emerging markets, and that's when we're talking about China and Brazil and India and so forth. Valuations are even more reasonable because they have done really poorly the past 10 years or so. So valuations there are almost like 10 to 11 times earnings. Again, the big country in emerging markets is China, which grabs a lot of headline news, and there's a lot of headline risk. They have this zero COVID policy. So every time there's a case, they shut down the big parts of their cities, and that's obviously has been very negative for the markets. But China is a large country, so is India. Again, one thing to kind of keep in mind is India, for example, just recently passed the UK as the 5th largest economy in the world. And when you're looking at India's population, majority of it is 20-some-year-olds, which is not the case in the Western world. So what's different now versus 20 years ago is that all these younger people in emerging markets are all connected. They all have smartphones. They do banking online.
The growing middle class.
Absolutely. And that whole e-commerce is a bigger topic in emerging markets and even in the US. So there's a lot more e-commerce doing transactions online in China than there are in the US. So I think there is good reasons to be globally diversified. Again, we don't know when that tide is going to turn. And nobody's arguing right now that we should be overexposed to emerging markets or to international. But kind of having that exposure globally, I think, makes sense.
Yeah, I mean, you put a couple things in perspective. Like if you're a consumer at a grocery store and you're going to go buy a product, US is more expensive than Europe, and Europe's more expensive than emerging markets. So if you want value for your money, you're going to be looking at Europe or emerging markets as a consumer or as a shopper for investing, because valuations or prices are cheaper.
Exactly.
What are your, you hit on a couple of components in terms of size. The US has 350 or 370 million people. The world has 6.5 billion, give or take, or closer to 7, right? So just in that perspective, when you're looking at investing around the globe in the growing middle class, you want exposure to some of the largest areas of the market, which can be emerging markets or even international. What are your thoughts around people that say right now is a good time to invest in international stocks because the dollar is so strong? What are your thoughts on that?
Yeah, I think that again, I mean, let's think about for a second why the dollar is strong. And I think the U.S. has been more aggressive raising rates versus Europe. Europe is going to also raise rates pretty soon, maybe 75 basis points as well. So the fact that U.S. markets, when the Fed is raising rates, you're looking at the 2-year Treasury, which was yielding below 1%, now is yielding 3.5% or so. So U.S. assets become more attractive to international investors. So the stronger U.S. dollar is attracting more assets to the U.S. because why would you invest in a Euro bond where you can get 3.5% in US. But again, when you adjust that for inflation, it's not as attractive. So strong US dollar is attracting assets to the US, but also it's going to not be positive for the earnings of US companies. Mm-hmm. So I think just kind of look, those things kind of over the long term, I think they'll kind of cancel each other out, and the effect of the US dollar. You have to really look at the fundamentals of companies. And when you're looking at Europe, for example, companies that are in Europe, Nestle, for example, mm-hmm. I mean, it's big chocolate and candy maker.
Yeah, I love chocolate.
Yeah, that's, you're looking at all the German cars. You're looking at SAP, which is a technology company kind of in line with what Oracle does in the US, but at a much lower valuation. Yeah. So all those are attractive companies. And I think the fact that currency fluctuations and kind of perception of where risks are higher has sort of dampened the valuations of those companies. So that's why I think it makes sense to have exposure. Again, not be overexposed, but have some kind of exposure to those kind of companies.
So the main talking points for why international stocks is the diversification against US in the event of a lost decade again with US stocks. Again, no one has a crystal ball, but international the next 10 years could potentially outperform the US with the challenges that we're facing. And the fact that valuations are so cheap, it's much more attractive from an investment perspective because they're not as overpriced compared to US stocks. So those are the main takeaways.
Absolutely. Yeah. I think you hit on them really well. I think those are the main things. Again, you want to maintain that home country bias, but you don't want to ignore
the rest
40% of the market capitalization, which is outside of the US.
Sasan, thank you for joining us today. It was a pleasure, and I hope everybody got something to take away from it.
Yeah, thank you, Chris.
Yeah.